August is often a bad month for investors, so if you're worried about crashing stock markets, bear in mind there's a seasonal element to the mayhem we're seeing. In the past 5 years, the UK's FTSE 100 has either tumbled in August, as in 2010, 12 and 13, or if the index has avoided a crash, it's been part of a grim summer, as in 2011 and 2014. From that perspective, this August is no different. Not that I'm suggesting nothing serious is going on, but if you can adopt the chilled out attitude of a basking holidaymaker, it's probably a good thing. The important point is not to panic and dump your falling investments, but to calmly assess what's going on, see if you need to make any adjustments to your investments, and even look for buying opportunities. That's because there's every chance that some shares and markets will have fallen too far and will bounce back. So what's happened to cause the dramatic declines we've seen? Since the 11th of August, when China devalued its currency, the FTSE 100 has crashed 12% from 6,736 to below 6,000. A 4% plunge on Monday, the 24th of August, took the FTSE back to where it was nearly 3 years ago. Markets in Asia, other emerging markets, Japan, the US and Europe have also dived, but not as much. The Chinese authorities claimed lowering the price of the yuan by 3%, its largest fall in 20 years, was about making the currency more responsive to market movements. Everyone else saw it as a bid to boost China's exports by making the country's products cheaper to buy. The currency devaluation has crystallised long-standing concerns that China's slowing economy will hurt the rest of the world. That's because a cheaper currency will sap China's ability to buy goods and services from other countries. There are also fears of a currency war as China's neighbours respond with devaluations of their own. This could send a wave of deflation or falling prices across the world that will destabilise markets further. Adding to these fears, the price of oil plunged to a new low, reflecting the cloudy outlook for global growth as well as their glut in supply as oil countries like Saudi Arabia refuse to cut production. All of this comes as the US prepares to raise its interest rates for the first time in 9 years. This will be a massive event in stock markets, signalling an end to the easy credit conditions that have lifted bond, share and property prices since the 2008 financial crisis. The trouble is, although the US economy is doing okay, it's not growing as fast as expected. Investors fear the US Federal Reserve will make a mistake in raising rates too soon, choking off a fragile recovery. On Monday, both the dollar and the pound fell as traders bet that the Fed and the Bank of England would delay a hike in interest rates to let markets settle down. That offered some relief to emerging markets which have suffered as Western investors have shifted their money to the US in the hope of a better return. But why has the FTSE 100 done so badly? The index has suffered because many of the world's biggest mining companies are listed on the London Stock Exchange. Their shares are crashing as demand from China for steel and copper falls. The UK's big financial services sector is also always vulnerable when stock markets fall. Miners and financials were the big fallers on Monday. A handful of FTSE stocks have risen in the past month though, which shows that even when conditions are tough, it's possible to make money. As I said, the important thing is not to panic. Consider what your long-term goals are and see if your investments in ISAs and pensions are positioned correctly. No one knows what markets are going to do, so it's important to spread your money widely. As an example of the kind of diversification you could consider, this chart shows how professional wealth managers split their investors' assets. Emerging markets now account for just 2%, down from a peak of 11% 3 years ago, according to asset risk consultants. As for buying opportunities, lots of markets and companies look cheaper than they did a few months ago. One interesting area are funds investing in UK smaller companies. UK smaller companies are less exposed to the global economy and some of the pressures I've been talking about, but are much more geared to the UK economy, which is doing comparatively well. However, their shares can be volatile when markets are rocky, so there are risks. That said, there are lots of good fund managers in this sector, so if you're looking to invest some cash and take advantage of the market lows, that's one area you could look into.